first thank the organizers, Juan, Tim, for this invitation. I'm the least known person in this panel, but in spite of that, I would just say that I'm a very humble regulator, probably the only one in this room. But I would like still to say a few words before starting this session. Definitely, the title of the session is very thought-provoking, Bank Recapitalization During and Since the Great Recession, Right or Wrong, with a big question mark. Bank recapitalization has been one particular aspect of the policy response to the Great Financial Crisis. And as a matter of fact, it has been argued that we speak of the Great Recession and not the Great Depression, thanks to the role played by central banks and fiscal authorities. Fiscal authorities have provided generous financial support to the financial system, and central banks went beyond just cutting interest rates or even expanding collateral to the most controversial quantitative easing, that it has been controversial in terms of the amount, the type of assets bought by central banks, and the vast increase in the size of the central banks, that it has raised concern about the soundness of the central banks and particularly of their independence from the government. Quantitative easing could ultimately be inflationary. This has been also a concern. And others argue that simply would be ineffective in the conditions of a Keynesian liquidity trap. The job, it had to be done by fiscal authorities. Also, financial regulators, and this is going to be mostly the topic of this session, responded to the Great Financial Crisis, and the response was incremental and strategic. The most controversial one seems that it has been the increases in capital, both in quantity and quality. Some of the critiques came from the front that saying that by limiting leverage of the banks, this leverage could move outside the banking system to other sectors that were outside the scope of central banks. And also that increases in capital do not guarantee increases in long-term economic growth. And in this regard, I found very interesting that Jaime Caruana, farewell speech at the BIS, he regretted, specifically lamented that the BIS had not done a better job in convincing the economic community of the benefits in terms of growth, of increases in capital. So the regulatory response was not only in terms of capital, but also in terms of liquidity. I think that for the first time, short-term and long-term liquidity are going to be closely monitored by regulators. And for me, what it has been the great game changer, and this will bring me to the first paper of today, has been the development of the too big to fail policy. So, in my view, for the first time, regulators changed the focus, and it's not so much about capital as a going concern, but also you are at risk. Because not anymore you can take for granted that you are going to receive public support. Okay, and I think this has been, in my view, the big game changer in the post-crisis regulation, and all of this is under the umbrella of the so-called too big to fail policy that aims at reducing moral hazard, just what I said, that policymakers should have no other option but to save an institution as a whole, and restoring market discipline. I mean, for those of you who are interested, very interested in the Global Financial Stability Report of the IMF in 2014, showing the rating gain associated with implicit government support. You will see how Eurozone banks, British banks, and US banks were rated. Said that, let me just give the floor to the speakers. As I just said, all of them are well known in this community. These three papers deal with very interesting aspects of the bank recapitalization in the aftermath of the crisis. Two of them are more focused on bank capital itself, and the third one on the consequences in terms of money growth. Without much to say, Geoffrey, the floor is yours, and looking forward to what you have to say. You know you have 25 minutes. So that we'll have some time for discussion afterwards.
Madam Chairman, thank you. I don't dare call you anything less formal than Madam Chairman in the present atmosphere in Westminster, and so otherwise the IEA may call the police. So, Madam Chairman, 25 minutes is, I think, more than we shall need. Because the argument of this paper, by Forrest and myself, is a very simple one, and indeed it was stated by Adam Smith. The basic argument was stated by Adam Smith in what is perhaps the most famous quotation in economics. It is not from the benevolence of the butcher, the baker, and the brewer that we get our meat, our bread, and our beer, but from their own self-interest. Well, we will argue today, this morning, first, that the evidence, the experience of British banking, the history shows that it is not from benevolence, but from their own self-interest, and indeed in a period of decreasing regulation, that British banks became increasingly stable as time went on. They were ultimately at their most stable when they were regulated only by normal company law, like any other company. There was no special regulation, no special supervision. And that instability increased when supervision increased. The two went together, instability and supervision and regulation of time hand in hand. I should say that Maria, in her introduction, described herself as a humble regulator. I'm tempted to say that I think all regulators should be humble, with perhaps the exception of Maria. But I shall certainly persuade you of the general case, I hope, this morning, or we shall. The central point, I think, to grasp about banking is that it really is a very old business indeed. And I should say, when I talk about banking in this context, we're talking about the kind of classic bank which takes in deposits and makes loans. We're talking about the core function that matters to monetary stability. And I emphasize that now because the core function is, as we'll see, what Volcker and Vickers are both concerned to preserve, and rightly so. These banks have changed essentially not at all from the medieval goldsmiths we tell our students about. They took in gold, lent some of it out, and so learned that they could lend a bit out depending on how the flow of gold in and out of the bank. Capital then comprises banks. To do this kind of business need two things. They need capital and they need liquidity. They need liquidity, a slightly tricky concept to define, because the day-to-day flows of cash into and out of a bank do not necessarily balance day-to-day, although they tend to balance on average. There are special episodes when they don't balance at all, and I shall touch briefly on those in a moment. Capital, on the other hand, is needed, because now and again, regardless of how well run a bank is, regardless of how well it treats its customers, people will default on loans. This will happen through the inevitable uncertainties of life, and of course uncertainties, unlike risks, cannot be evaluated. So they need capital, their own money, to pay people back if people do not pay them the banks back, and they need liquidity. Now this necessity for capital and liquidity does not arise, of course, with all types of banks. There can conceivably be banks which don't engage in fractional reserve banking, as it's called, which simply take money in, look after it for you, and give you it out again. Henry Simon discussed this type of system in the 1930s, and he described it. He originated the term cloakroom banking for that, because of course they behave exactly like a cloakroom. You take your hat in at the start of the evening, and you get your own hat back at the end. And the cloakroom is nothing but what you industry. But cloakroom banks don't exist today in any significant form anywhere in the world, and they certainly don't exist in Britain or any other country with which we're concerned today. Let me turn now to the problems of losing capital. When a bank starts to lose capital, it's usually through persistent bad lending. They usually diversify, indeed they usually did diversify, so that no bad loan can bring down the bank. Hence banks, if they're losing capital, tend to crumble away rather than collapse overnight. The classic example of this in living memory, indeed, is Midland Bank, as it then was, which became weaker and weaker through a series of bad loans and bad takeover transactions, until not only suffered the ignominy of a takeover approach by its advertising agency, but it was ultimately forwarded into HSBC. Failure through liquidity is a much more rapid concept. It can come from a rumour or a fact that the bank is short of cash, and people hasten to withdraw their funds while there are any funds left. A classic example of such a run is, of course, that on Down, Thornton and Free in 1810, one which Henry Thornton, the great economist and banker, was a junior partner. It was almost brought down by a run that started before lunch, brought down in the day by a run that started before lunch. Is described in some detail in perhaps E.M. Forster's least known book, a biography of Thornton's sister, Maria Nieto. If any of you are puzzled that Forster should write a biography of a minor figure is because he was related to her and to Henry indirectly. And he did it as an act of family piety. And it reads about it as vividly as most acts of family piety do, but it's a very interesting book from the point of view of the history of banking. The bank survived the episode, but failed after Henry Thornton's death. Now, having set out the background then, why you need capital, why you need liquidity, and why you fail more gradually through loss of capital than loss of liquidity, let us now turn to some facts. The behaviour of capital ratios in 19th century British banking. First of all, we should note that capital has been recognised as important by central bankers, there were no regulators in those days, for a very long time. Indeed, so important was it that commercial banks in Britain were allowed to keep hidden reserves, keep reserves concealed. Strong capital positions are, of course, designed to give depositors confidence. Indeed, the publication of capital ratios started in Britain in the 19th century by, if I remember, the Lincoln Bank as a competitive weapon to say, look how well capitalised we are, your money is safe with us. And this drove the competitors, again an example of the benefits of competition, this drove the competitors to hold higher capital ratios. But also, holding hidden reserves served two purposes. It meant everyone knew the banks were stronger than they looked, but they didn't know how much stronger they were. And of course, they could use these hidden reserves to smooth profits, so that there were no big fluctuations in the profit stream of the banks likely to alarm the customers, and that's very important. In this period, there was no regulation at all as to what proportion of the balance sheet capital or any other liability or asset might be. Indeed, across the middle two quarters of the 19th century, the regulations were gradually removed. The usury laws and compulsory unlimited liability were both removed, and each bank in this free environment had to find its own way to the appropriate balance sheet structure it wanted for its own individual business. There had been, of course, financial crises in and in the aftermath, or banking failures, I should say more properly, banking failures, in and in the aftermath of the wars with France. And banks started, therefore, with very high capital ratios. These started to come down very slowly and gradually as they learned more about their customers, more about their competitors. And there was a further fall when the Bank of England committed itself explicitly, essentially, to act as a lender of last resort. Hence then, we had a period of gradually declining capital ratios, different for each bank, at the same time as banking stability in Britain has actually increased. The number of bank failures diminished, and they diminished also in size. This was, of course, assisted by the lender of last resort action of the Bank of England, containing liquidity losses, but losses from either source, I should say, gradually diminished. By the beginning, then, of the final quarter of the 19th century, published capital ratios had settled at around 15%, with a little variation, not much, but a little variation across banks. And by the end of the 19th century, the figure was 10 to 12%. The discount houses, a very specialised form of bank, held much lower capital ratios, but then they also had very, very detailed knowledge of their customers. An example of the detailed knowledge from modern times, I suppose, again, you've probably all heard of Bank of Credit and Commerce International, BCCI, Bank of Cocaine and Corruption International, as its friends here. When that failed, there was considerable alarm in the Bank of England because they were afraid this might threaten the discount houses. So the discount houses were called, and the essential response was, what lend money to them? They didn't tell us enough about the business. We didn't know enough to lend to them. The discount houses, in other words, had intimate knowledge of their customers and protected themselves that way. That's not to say they didn't fail, they did fail, but not generally through capital losses through bad lending. Now, there were changes in the 20th century. And these changes in the 20th century were initially prompted by inflation, which of course was only a 20th century phenomenon in Britain. Didn't occur before. But banks didn't worry about this because much of the capital ratios failed was the lending largely on government debt, and since government debt was in nominal terms and the other side of the balance sheet was in nominal terms, government debt was then believed to be completely secure. And it was largely British government debt they were holding. Banks then started to adjust the capital according to the risks they were taking. And in the years between the two world wars, the years you will remember of immense economic turmoil in continental Europe, in the United States, of course, extraordinary economic turmoil, Now, the picture painted by the British banking sector was one of remarkable stability. Because of this and indeed remarkable stability for the economy, this, I think, suggests another reason for the symbiotic relationship between monetary and financial stability. Monetary stability helps to keep the banking system more stable, and the stability of the banking system prevents panic scrambles for cash, prevents collapses in the money supply, and thus produces monetary stability. They help each other. Well, because of this stability, capital ratios drifted down further in the 20s and 30s. And by the end of the 1930s, they had settled around 7%. In the Second World War, then, capital ratios fell again. They fell to around 3%. These balance sheets, however, were expanded with government debt, and private lending essentially fell away very rapidly, and there was very little of it left on the bank's balance sheets by that period. And as this ratio fell, so did the risk in nominal terms fall, because people were completely confident that the British government would repay its debts, and of course, had Britain been invaded and conquered, then it might not have repaid its debts, but people would I think, have had more serious matters to worry about. Capital ratios continued to drift down after the war and reached their all-time lows of around 2% in the 1950s. Raising capital after the war was not terribly easy. Indeed, one of the difficulties was placed in its way was the behaviour of government. There was a body called the Capital Issues Committee, a body which restricted access to capital markets by private borrowers so that the market would be much freer for government to borrow from. So this restriction, however, began to be troublesome, unsurprisingly. Private sector demand for lending picked up, and banks wanted to meet it. So bank chairmen spent a lot of time in the 1950s lobbying the Bank of England for support to let them raise more capital. The banks said, we want to raise more capital, why are we being stopped? Not from the chief cashier of the time makes the problem clear. Let me quote. It will be seen that the capital structure of the clearing banks is far from sound. At present, it is clear that in times of trouble, they must either put footnotes on their balance sheets, which we deplore, or lean on us for financial aid, which would be disastrous. The banks, if freed from restriction, that's an important qualification, if freed from restriction, should pursue energetically the implementation of a program which, for good reasons, is long overdue. And I emphasise again, it was the banks themselves that were seeking to raise more capital, not the government or the regulators, who did not then exist, who were forcing them to do it. Well, the capital ratio did slowly come back and reached around 4 or 5% in the 1960s, being raised and falling that way. And these figures, note, are all the figures that were being actually presented to the public eye. They're in the balance sheets. It was well understood, and closer examination confirms this, that there were hidden reserves, which both allowed a smooth picture of business, flow of profits, and made sure that the banks were rather more stable than they was presented. And when the true positions, adjusting for these hidden reserves, are presented, capital ratios rose across the board by at least 1%, in some banks more. And furthermore, should capital weightings of the Basel type be applied to these ratios, of around 4%, the figures would appear dramatically higher. For the 1920s, Basel type ratios would show around 14%, and those of the Second World War would again turn out to be over 14%, largely because of the amount of government debt in the bank's balance sheets. And in the 1960s, capital ratios, thus adjusted, would have been the order of 13%. And now we come to a very important point, the fact that banks chose their capital ratios according to their own business. Lloyd's chairman drew attention to this in some remarks in the 1950s. There is no rule of thumb method. Here's a lesson for regulators. There is no rule of thumb method of deciding the size of capital funds which a bank needs to carry on its business. The guiding principles are that the resources as a whole must be sufficient to provide absolute security for our depositors and sufficient reserves to meet fluctuation in our trading from year to year. Provision must be made against the difficulties associated with fluctuation in the market price of note-hedge stock, then still an important part of banks' portfolios. Note then the emphasis on judgment, the acknowledgement of responsibility. In my conclusion in a few moments, how long do I have left, Maria?
You still have a few minutes, 5 minutes.
I won't need 5 minutes. I'll come before my conclusion to this importance of individual responsibility. And now we come to the secondary banking crisis, a time of inflation. And at the same time, when banks wanted to raise more capital, from 1972 to 74, that was the biggest stock market fall to date in the UK. The main index fell from 533 in May 72 to 160 in January 74. Bank shares fell worse than most. Some fell by as much as 70%. Now, there was no threat to the main banking sector, but there was a threat to something called the secondary banking sector. I should note as an aside, the secondary banking sector, which indeed did prove very troublesome, was itself a creature of regulation, encouraged by it. The Banking Act, passed in 1979, in response to this failure caused by regulation, placed limits on individual exposures exceeding 25% of capital required prior approval of the banking. That was designed to ensure appropriate diversification, and soon after that, in the 1980s, the role of Basel table. Basel, or Basel, depending on how you prefer to pronounce it, was prompted by two bank failures, Bank Herstatt and Franklin National, both of which were handled rather badly, but they led to the formation of a standing committee of banking supervisors, and it started to concern itself with regulation, with capital regulation in particular, in 1988. And the Basel Accord of that year established what are called capital adequacy standards. They defined capital ratio, obviously. The risk assets ratio is capital divided by risk assets. Capital divided into two tiers. Already we observed the intrusive detail of excluding judgment. Capital was divided into two tiers, tiers 1 and 2. Tier 1 comprising mainly equity capital, the first line of defense, and tier 2 supplementary capital, instruments such as loan stocks and subordinated debt. It did, however, recognise only one risk, the risk of default. And each asset held by a bank was assigned to, as it called it, 5 risk buckets. And each of these had a different degree of risk weighting. The higher the risk weighting, the higher the capital required. Note that, very interestingly, weighting was based on the generic nature of the borrower. No attention whatsoever was paid to individual risks. Rolls-Royce was regarded as risky, as a newly started call on news agent. And the government of, let us say, Venezuela will get the same risk weighting, that is to say 0, as the British government. Remarkable, really. It has also been observed by Sheila Heffernan, our late colleague Sheila Heffernan, that these are not anomalies, such as lower risk weighting for off-balance sheet transact lending than balance sheet then on-balance sheet lending to the same borrower, led to arbitrage, regulatory arbitrage. Of course, banks didn't engage in arbitrage when they chose their own capital ratios in the light of their own business, because they didn't want to fail. But regulatory arbitrage was all right, because this was a way of being more profitable, and they thought the regulators were making them do foolish things.
Jeffrey, be mindful you just have a minute.
Half a minute? And
One
minute more to abuse regulators, isn't it? So we can then rapidly move on. Basel tried again. So 3 pillars for financial stability. With a risk pillar, market discipline pillar, and capital pillar. These two seem to fail in the recent banking crisis. What should be done? And we have Vickers and Volcker, the proposals to ring-fence banks. Now, as Charles Goodhart, for example, has notably remarked, these proposals to separate banks are, from one point of view, at least in Britain, notably perverse, because British banks were by and large propped up by their investment banks. It may not be true elsewhere. It certainly helped stabilise British banks. But although perverse from that point of view, they also did something very useful. By separating out normal commercial banks, you turned them into organisations that could, at least in principle, be closed promptly in an orderly fashion, just like Corn and Newsagent or just like Marks and Spencer's. A big job, but doable in principle. And this is immensely important for banking stability. If we think back to the 19th century, to the period of lack of regulation, to the period of individual responsibility, when indeed people were sometimes risking their own money by investing in banks, we observed then that stability increased because people learned what to do and they avoided unnecessary risks. If again they know that the bank can fail, if again they know that they are responsible and their shareholders will hold them responsible, then the system will be more stable. If, in other words, we return to a system where it's not from benevolence that we have stable banks, but from their own self-interest, we will have a much more stable banking sector and a much more stable financial sector.
Thank you.